March 10th, 2023. Silicon Valley Bank, the 16th largest bank in the United States, collapsed in 36 hours. $42 billion in deposits were withdrawn in one day. The largest banking collapse since 2008. 2 days later, Signature Bank collapsed. 2 months later, First Republic Bank collapsed. 3 of the 4 largest bank failures in the history of the United States occurred within 8 weeks. Could depositors have noticed the signs? Yes, all the red flags were visible months before the collapse, but most people did not pay attention until it was too late. Today you will learn 5 signs that your bank is in danger and how to protect your money before panic begins. Sign 1. Falling profits and growing losses. Banks make money when they invest depositors' funds at higher interest rates than they pay out. Declining profits can be a clear sign that a bank is moving toward collapse. How to check this? Go to the FDIC Bank Find Suite website at fdic.gov. Enter the name of your bank, open the financial reports. 3 key indicators. Return on assets, profitability of assets. This shows profit per dollar of assets. The norm is 1% and higher. Below 0.5% is a problem. Negative means the bank is losing money. Return on equity, profitability of capital. The norm is 10 to 15%. Below 5% is an alarming signal. Net interest margin, the difference between what the bank earns and what it pays. The norm is 3 to 4%. Below 2% is an unprofitable model. Example of Silicon Valley Bank. The market value of Silicon Valley Bank bonds fell significantly in 2022 and 2023 when the Federal Reserve raised interest rates to curb inflation, causing unrealized losses in the portfolio. By the third quarter of 2022, unrealized losses amounted to 110% of the bank's capital. Silicon Valley Bank was technically insolvent, but the information was public in the reports. No one looked. What to do? Check reports once per quarter. If return on assets falls for 2 consecutive quarters, start diversifying. Sign 2, a high percentage of uninsured deposits. This was the main killer of Silicon Valley Bank. Silicon Valley Bank stood out because it had more than 90% uninsured deposits. For comparison, on average, other mid-sized banks had 44% of deposits uninsured. What does this mean? The Federal Deposit Insurance Corporation insures deposits only up to $250,000 per depositor per bank. Everything above that is uninsured. If a bank has many clients with balances above $250,000, large companies, startups, wealthy individuals, that money is not protected. Why this is deadly. Owners of uninsured deposits are nervous. At the first signs of trouble, they immediately withdraw everything. This causes a bank run, a mass outflow of deposits within hours. At Silicon Valley Bank, 88% of deposits were uninsured. When clients panicked, they withdrew $42 billion in 24 hours. The bank physically could not cover the withdrawals. Collapse. Dangerous levels. More than 50% uninsured is a red flag. More than 70% is critical. More than 90%, as with Silicon Valley Bank, means catastrophe is inevitable. Where to look? In the bank's quarterly reports, Forms 10Q and 10K, look for the terms uninsured deposits or estimated uninsured deposit ratio. What to do? If the percentage is high and you hold more than $250,000, immediately open accounts at different banks. Keep no more than $250,000 in each. Sign 3, a falling bank share price. One of the clearest indicators of trouble is a sharp drop in the share price of a regional bank. Investors often react quickly to signs of instability. Why this works? Shareholders analyze the same financial reports available to you, but they do it professionally. If shares fall without a general market decline, investors see problems. The story of Silicon Valley Bank, February 2023, $267 per share. March 8th, after the announcement of a bond sale at a loss, $106, a drop of 60% in one day. March 9th, $39, another 60% drop. March 10th, the bank was closed by regulators. As of January 31st, 2023, the short position in Silicon Valley Bank and Signature Bank was 6.1% and 5.1% respectively, compared with an average of 2.6% for the rest of the peer group, indicating that short sellers targeted specifically banks with poor risk management. Professional investors knew Silicon Valley Bank was in trouble 2 months before the collapse. They bet against the bank. Ordinary depositors did not notice. What to watch? A drop of 20% or more without a general market decline. A drop of 50% or more over a short period, 1 week to 1 month. Short interest above the sector average. What to do? Check share prices once per month using Yahoo Finance or Google Finance. A sharp drop is a signal to find out the reason. It may be time to withdraw money. Sign 4, withdrawal restrictions. The most alarming sign is when a bank begins to restrict withdrawals or introduce unusual fees. These measures indicate liquidity problems. meaning the bank may not have enough cash to meet customer demands. Examples of alarming signals include limits on daily cash withdrawals that did not exist before, transfer delays described as technical problems, new withdrawal fees, restrictions on account closure, such as a requirement for 30 days notice, and automated teller machines constantly showing no cash. What this means: the bank does not have money. It is trying to slow deposit outflows to avoid immediate failure. Withdrawal restrictions destroy trust and often trigger panic among depositors. Once trust is lost, a bank run can occur, accelerating collapse. What to do immediately? Withdraw the maximum allowed. Open an account at another bank today. Transfer the remaining balance there. Do not wait for clarification. By then, the bank may be closed and you will be stuck in the Federal Deposit Insurance Corporation process for weeks. Sign 5. Excessively rapid asset growth. Rapid growth can signal risk. From 2019 to 2021, total assets of Silicon Valley Bank and Signature Bank grew by 198% and 134% respectively, far exceeding the growth of a group of 19 competing banks where median total asset growth was 33%. Why rapid growth is dangerous. When a bank grows too fast, it takes on riskier clients, lowers lending standards, invests in risky assets, and fails to build risk control systems in time. Healthy bank growth is 5 to 10% per year. Growth of more than 100% per year is a red flag. Silicon Valley Bank nearly tripled in size in 2 years. This is abnormal. Where to look? In financial reports using FDIC Bank Find, check total assets and total deposits. If growth exceeds 50% in 1 year, this is a reason for concern. In addition to the 5 main signs, there are other signals that cannot be ignored. Red flag 6, concentration in a single industry. Silicon Valley Bank was a technology-focused bank, Silicon Valley, California. Many of its clients were technology startups, which meant there was a concentration of money from only one sector. When the technology sector declined in 2022, all of Silicon Valley Bank's clients began losing money at the same time and withdrawing deposits. A diversified bank would have survived this. What to check? If your bank specializes in a single industry such as oil and gas, real estate, technology, or crypto, it is vulnerable to a crisis in that industry. Red flag 7, low liquidity. Liquidity is a bank's ability to quickly convert assets into cash. Using the loan-to-deposit ratio of Silicon Valley Bank, which is a liquidity indicator, the data shows low liquidity at the moment of collapse. This became one of Silicon Valley Bank's main vulnerabilities because its assets were not easily convertible into cash. Key indicators: loan-to-deposit ratio. The norm is 80 to 90%. Above 100% is dangerous. Cash to assets ratio. The norm is 5 to 10%. Below 3% indicates low liquidity. Silicon Valley Bank held most of its assets in long-term bonds. When cash was needed, it could not sell them quickly without massive losses. Red flag 8, large unrealized losses. Seeking higher investment returns from growing deposits, Silicon Valley Bank significantly increased its investments in long-term securities, starting in 2021. Silicon Valley Bank bought long-term bonds in 2020 and 2021, when interest rates were 1 to 2%. In 2022 and 2023, the Federal Reserve raised rates to 4 to 5%. Older bonds fell in price. Unrealized losses at Silicon Valley Bank amounted to $17 billion. When clients began withdrawing money, Silicon Valley Bank was forced to sell bonds at a loss of $1.8 billion. This triggered panic, a bank run, collapse. What to watch? In reports, look for the phrase unrealized losses on securities. If losses exceed 20% of capital, this is dangerous. More than 100%, as in the case of Silicon Valley Bank, is catastrophic. Red flag 9, poor management. As a rule, declining profitability has a cause, and it is usually poor management. Warning signs include frequent turnover of top executives, such as the chief executive officer and chief financial officer, fines from regulators, and the absence of a chief risk officer. From July 2022, when Silicon Valley Bank Financial Group first became subject to enhanced prudential standards, it repeatedly failed its own internal liquidity stress tests. Management responded by expanding funding capacity, but actions were not taken quickly. Silicon Valley Bank knew about the problems. Regulators warned them. Management did not act. In addition, Silicon Valley Bank did not have a chief risk officer from April 2022 to January 2023. 9 months without a head of risk management. What to do? Search online for news about your bank. Look for phrases such as regulatory action, Federal Deposit Insurance Corporation enforcement, or the bank's name followed by the word scandal. A large amount of negative news is a reason to consider changing banks. Now you know the signs. Here's a concrete protection plan. Action 1, check Federal Deposit Insurance Corporation insurance. Look for the FDIC logo on the bank's website or in its branch. You can also use the Federal Deposit Insurance Corporation Bank Find Suite to check whether your bank is a member of the Federal Deposit Insurance Corporation. Critical point. If the bank is not insured by the Federal Deposit Insurance Corporation, withdraw your money immediately. Without insurance, you risk losing everything. Action 2. Respect the limit of $250,000. The Federal Deposit Insurance Corporation insures up to $250,000 per depositor, per bank, per account type. If you have $300,000 in one bank, $50,000 is uninsured and at risk. Solution? Open accounts at multiple banks with $250,000 in each, or use different account types at one bank. An individual account insured up to $250,000, a joint account with a spouse insured up to $500,000, meaning $250,000 per person, and an individual retirement account insured up to $250,000. In total, up to $1 million can be insured at one bank. However, for maximum safety, different banks are better. Action 3. Diversify assets. Do not keep all your money in one place. An optimal structure is 60% of funds in the main bank, 30% in a second bank, and 10% in a third bank or credit union. Why this matters? Even if your main bank collapses, you have immediate access to 40% of your funds in other banks. While the Federal Deposit Insurance Corporation returns the rest, usually within 1 to 3 days, you are not left without money. Action 4. Keep a cash reserve. Keep cash at home to cover 1 to 2 months of basic expenses in a safe or another secure place. Why this matters? When a bank collapses, the Federal Deposit Insurance Corporation returns money quickly, but not instantly. A cash reserve allows you to pay your mortgage, buy groceries, and cover bills while you wait. Action 5. Monitor your bank's health quarterly. Every 3 months, spending about 15 minutes, go to the Federal Deposit Insurance Corporation Bank Find Suite. Check key indicators. Return on assets should be above 0.5%. The uninsured deposit ratio should be below 50%. Unrealized losses should be below 20% of capital. Search online for news about your bank and look for negative reports. Check the stock price if the bank is publicly traded. If you see 2 or more red flags, begin withdrawing money. Action 6. Understand what happens during a collapse. When a bank becomes insolvent, regulators intervene and take control. This usually happens on a Friday after closing to avoid panic and ensure a smoother transition. The Federal Deposit Insurance Corporation becomes the receiver and begins the process of either selling the bank to another institution or managing its closure. What happens to your money? Up to $250,000 is returned in full by the Federal Deposit Insurance Corporation, usually within 1 to 3 business days. You do not need to file an application. A new account will be opened at another bank, or a check will be sent. Amounts above $250,000. The insured portion is returned quickly. The uninsured portion may be returned partially after the bank's assets are sold. This process can take months or years. Your loans, if you have a mortgage or a car loan with a failed bank, you must continue making payments. Your loan will be sold to another bank. Action 7. Do not panic. Avoid impulsive financial decisions, such as withdrawing all money at once. When everyone panics, it can trigger a bank run, turning fear into a real problem. The correct strategy is to monitor signs in advance, act before panic when you see 2 or more red flags, withdraw money calmly and gradually, and transfer funds to reliable banks rather than holding everything in cash. Action 8. Choose reliable banks. Signs of a reliable bank include large size, typically among the top 10 to 20 in the United States. Diversified clientele rather than concentration in one sector. Return on assets consistently above 1%, an uninsured deposit percentage below 40%, and strong ratings from agencies such as Moody's and Standard & Poor's. Examples of traditionally reliable banks include J.P. Morgan Chase, Bank of America, Wells Fargo, and Citibank. However, even large banks must be monitored. In 2008, Citibank and Bank of America nearly collapsed. Action 9. Consider alternatives. Credit unions are insured by the National Credit Union Administration, an equivalent of the Federal Deposit Insurance Corporation, with the same limit of $250,000, and are often more conservative. United States Treasury bills are issued directly by the government, carry a 100% guarantee, offer high liquidity, and have yields slightly lower than bank deposits. Money market funds are not insured by the Federal Deposit Insurance Corporation, but invest in safe assets. The risk is low, but not zero. Final check, protection checklist. Do today. Check whether your bank is insured by the Federal Deposit Insurance Corporation. Make sure there is no more than $250,000 in each bank. If there is more, then open accounts at other banks, and keep cash at home to cover 1 to 2 months of expenses. Do quarterly. Check your bank's financial indicators, read news about the bank, and check the stock price. If you see 2 or more red flags, start withdrawing money, open an account at a reliable bank, and transfer funds gradually. Final thought. Most people learn about a bank's problems from the news, when regulators announce that the bank has been closed. By then, it is too late. There are lines at cash machines, panic, and frozen accounts. Successful depositors act in advance. They monitor the signs, see the red flags, and calmly withdraw money before a crisis. When the crowd panics, they're already safe. Banks collapse. This is a fact. In 2023, 3 major banks collapsed. In 2008, hundreds did. The question is not whether it will happen to my bank. The question is whether I will be ready if it does. Now you know the signs. You know the protection plan. Act. Your money is your responsibility. Do not wait for the bank to collapse. Monitor. Diversify. Be prepared.